Now we can look at, in this segment, where are we sitting with inflation? What does inflation look like? And this is a USD and euro inflation swap, 5-year, and you can see the shift higher continues to really drive off the bottom, and typically they move together, but obviously the U.S. has continued to outpace as our spending is obviously larger. But it's, again, we think the gap they'll try to close it, at least in Europe, as inflation, as we joked before. When you look at European inflation, food prices are up 4%, oil prices are down 5%. So they're like, oh, and there's no inflation. It's like, well, nobody's driving and nobody's really doing anything. So I'm not benefiting from the low oil prices, but I am getting hit with the high food prices. So when you say there's no inflation to me, you're joking, correct? But again, this is how they're trying to mitigate and show on how they can continue to spend without any real issues. But the issues are starting to get priced in as we continue to see inflation expectations moving higher. Now we're at about 2.3%. Which again is just above, obviously, the 2% target as we continue to see the curve moving up, pricing in more and more inflation fears, with the euro also doing the same. But even obviously, like, we're looking at some of the data in Western Europe, and it continues to be a problem overall as we see some of the pain continuing in large parts of the economic indicators, which we'll go through in a bit more detail, especially the German ones. But here we're looking at outstanding EM sovereign and euro bonds. So this is emerging market sovereign debt, and we're seeing an increase in European sovereign bonds because U.S. dollar is still obviously the reserve currency. You're still seeing an increase in U.S. dollar sovereign bonds. But why not take advantage of a strong euro and trying to mitigate against some of that? So here you have euro bonds being issued and especially if you think about Europe, European debt trading either at 0% or negative. Well, that means that there are people in Europe who need yield, and why not make it easier for them to borrow from me? And I'll just, instead of doing US dollar debt, I'll do euro denominated debt, and I'll be able to attract more people. So here you can see the share of European bonds has increased to about, let's call it 19.5%, which is a nice bounce from 2019, which was at about 17.5%. So again, 2% more, which is something that we'll see continue to increase as European investors look for yield and try to find something which is, again, moving into the emerging market sphere of influence. And this is something similar as we've seen before, where Eurozone consumer confidence remains depressed, even though retail sales have stayed fairly elevated. And you can see just from historics, these typically go to meet each other. And as we look at some of the data here, where we have some GDP estimates, coming in a little bit light. Manufacturing conditions have gotten a little bit better in Italy, surprising to the upside in December. But again, it's more the retail sales where we did see some surprises to the upside. But the consumer confidence is going to inherently act as a anchor, and will act as that gravity that's going to drive it down. Not saying they're going to meet just because there's a lot of stimulus, there's a lot of things going in where people might feel bad about the economy or not confident about where things are going to go. But it's if you have the money from the government, then you still have the ability to go out and purchase and to maintain some of those sales, again, which is going to be the offsetting component for that. But when we look at timeline for the phase out of support measures, this is what we need to look for in terms of where are they starting, so where tax deferrals, short-time work schemes, loan moratoriums, public guarantee. These are problems where as we go into the end of the year, some of these programs are starting to end, specifically in France, Italy, and this is going to be put that pressure. So even though, consumer confidence is weakened, but retail sales have been strong. But as retail sales will start to come down as some of these programs end, and you're going to see some of these benefits go away, which is going to reduce the amount of retail sales, which is going to act as that headwind heading into Q1. But when we look at German roads, again, like this is something that we've seen in the U.S. miles driven by trucks is up 10%. Miles driven total interstate down 4% because people aren't driving their cars, but trucks are being driven. Same thing in Germany. We are seeing more stuff being moved on trucks as toll miles continue to shift higher. Now, again, you can see the pressure still remains, but again, this is a bright spot, and we see the numbers being supported recently in some of their IFO numbers, which we'll talk about in a second. Because production in the construction sector, Euro area, EU, has dipped down, and it's just we're not seeing the same type of recovery, especially as we have more pressure being pushed into the market from the issues that are arising from COVID restrictions getting pushed back in, the UK new strain, all of these issues in terms of British exit. What does it mean for fishing? What does it mean for shipments, for tariffs, for VAT taxes? Like these are things that are going to put people or cause people to pause on a much bigger level as we see some of these shifts. But again, this is something that could have been said 4 years ago. So, and yet we've seen some of this, steady increases. So it's something that it can recover. It's just going to be a matter of how quickly do we recover. Then when we look at the debt surge, again, Germany is borrowing a record amount to tackle this pandemic. That is not going to change, as you can see, based on federal debt issuance in billions of euros. 2021 is going to be no different. We're going to continue to see that borrowing. That's going to continue to shift higher. So Germany is really the country that helps support the valuation of the euro. So as the debt continues to rise at what is supposed to be a net exporting country, someone that has a positive account balance, like these are things that are going to start to weigh or should start to weigh on the euro and just the health of the eurozone in general. But when we look at most emerging markets have tightened restrictions, like this is where we continue to see some problems because emerging markets are tightening restrictions. So as emerging markets are increasing their restrictions, that's something that's happening as Europe is tightening restrictions and the US is tightening restrictions. And these are things that are going to weigh on general activity because when we look at current December 11th restrictions, you see Indonesia, India, China starting to increase a bit, Russia. These are things where, again, as it relates back to Europe, as it relates back to the US, these are reasons why as the US and Europe import less, export less, they're going to import less from these countries as their restrictions increase. General economic activity is going to slow, which again is just going to put more pressure, leading to issues as we head into the new year. With new hiring still under pressure. So even though Germany has seen toll miles go up, France has started to see some loosening of restrictions, you're still not seeing new hiring increasing. You're still seeing pressure continuing to mount. And, and this is into just October. So as we go into where the lockdowns continue to increase, as we went into November, into December, the trend is going to be moving in the wrong direction. Now, when we look at business climate in Germany in general, you can see that the business climate is, the views have started to get a little bit better. Business expectations of shifting up in manufacturing, which given what we've seen from PMI, makes sense. All of this data surprise to the upside. Service sector starting to bottom, but really not getting to the same type of level that we'd like to see, where construction assessment of business situation is fairly better, but business climate, business expectations, again, this is going to act as a headwind as we talk about that construction and those movements, where trade is kind of bifurcating, where business expectations are getting worse, business climate is flattish, but expectations are dwindling as we look at U.S., emerging markets, China. So even though the situation has gotten better, expectations of the future have gotten worse, which again has kind of pulled some of this down. So you have to understand how this is being looked at. And as we continue to see retail sales, in Sweden got a little bit better, but again, nothing that is going to drive us to the next level. where consumer confidence in Germany, again, the expectation was for down 7.6, came in down 7.3, but is still worse versus last month, because last month was negative 6.8. Again, we're moving in the wrong direction for some of this confidence, which we're seeing here when you look at the business cycle clock, where the expectations are for a continued downturn across both business expectations and assessment of business situation, where things are starting to move a little bit better as we've kind of cycled through, but we still remain trapped in this struggling component. And the reason why we look at Germany is because Germany, is the strongest of the European nations, and we're just not seeing them get any type of real traction that is going to help drive Europe to the next level, which is why we see a lot of this economic data, even though some of it is surprising to the upside, as we go not only through December, but into next year, the pressure is going to remain. And with the euro staying so strong, it's going to be a headwind for inherent trade, because it's just more expensive to buy stuff from these countries as the European currency remains elevated, dollar weakens, and a lot of currencies are either pegged to and or trade within some sort of range of the dollar. And as that weakens, again, that makes their currencies more expensive, makes the euro even more expensive, which again weighs on trade. All of these things are just headwinds to just total aggregated activity, which again will be a headwind as we go into 2021.